Will the Consumer Price Index, or CPI, keep dropping next year in 2025 and even go negative? People look at me like I'm nuts when I say we're going to see declining prices, but here's what Cathie Wood had to say about it. Link in the pinned comments below.
Productivity growth is surprising on the high side of expectations. So much so, and I will show you this in a minute as well, that the unit labor cost, so you take a compensation per man hour and you subtract productivity effectively, and you get unit labor costs. They were up only 0.4% on a year-over-year basis. So the Fed has been very fearful that the labor market would be the source of inflation, cost push inflation like in the 70s. It is not. Unequivocally, it is not. And I think because wages, employment, unemployment, all of these are lagging indicators, we're going to see, we think, much more productivity going forward as the unemployment rate goes up. And we think it's going to go up because companies are losing pricing power. Here we can go to monetary policy. So interestingly, you see that M2's growth has moved from negative into positive territory, but is still very low by historical standards. That's the purple line. In the green line, you can see the CPI, which it's not a perfect correlation by any means, but you can see the message from this chart because the money supply growth rate has moved forward. The message is inflation is probably going to drop. Let's see, the CPI is on the left-hand scale here, into the 1% to 2% range. And we would not be surprised to see it go negative as we did in 2020. And we saw in 2014 and 15, and even before that in 08, 09. So we think that will happen again, and that the Fed is going to be easing aggressively before all is said and done. And then to inflation itself as a worry. As you know, we've been keeping track of the Bloomberg Commodity Price Index, and you can see it is not breaking to the upside. It's actually breaking down. And so you see that it's still in the downtrend that started really in the 2008, 2007, 2008. So still in a downtrend. And you can see we were here back in the early 2000s, back in the early 1990s, back in the early 1980s. This chart is saying we do not have an inflation problem. Quite the opposite. We may be risking a deflation problem.
Here's the problem and the opportunity. The Fed needs to lower rates faster to head off a slowdown in the economy and a possible recession. If they leave rates too high for too long, the economy will suffer. If they lower rates too quickly and too far, then inflation could become a problem again. But if they lower rates at just the right pace and just far enough, the economy will function in a healthy way with low inflation. This will cause demand for housing, cars, and other big-ticket items to increase. And it will lower borrowing costs for all companies, but especially small-cap companies. What do you think this will do to the prices of stocks in the equity markets in general, and small-cap stocks in particular? Please let me know your thoughts in the comments below. With all that, let's go through the current health of the stock, bond, gold, and crypto markets. If we take a look at the price action for equities over the past 5 days, in other words, the last week, you can see we have a very healthy appetite for risk, with ARK Invest right up here at the top, an 8.5% increase for the past week. That's phenomenal. You've got NASDAQ second, small caps third, S&P fourth, and the Dow dead last. This is exactly what you want to see. And if we take a look at the last month, you can see it's been a rocky ride. There's been a pretty good pullback with a launch higher here recently. This looks very good. Year to date, ARK is still lagging way behind, but you can see that small caps and the NASDAQ 100 are moving rapidly higher here. And just for some recent perspective, if we look over the past 20 days, you can see that the market's been having kind of a rough time. It had a nice rally, kind of went sideways, fell off, and now we're back in rally mode again. But over this past week, it was a little bit tentative, finishing the week kind of on a down note. And how does all of this show up in the bottom dynamics? Well, if we take a look at the bottom dynamics, back here we had really a wonky market. You see there's no conviction. The bottom forming indicator, this orange line, was just oscillating all over the place. The bottom confirmation signal, this blue line, waffling all over the place. And the confidence level was fairly low, below 80%. And then all of a sudden we got kind of a strong upward move. Confidence level went up. We had a bottom confirmation signal here, and then the market started to pull back again. But where are we now? We're back in that kind of wonky area where these things are just kind of oscillating and the confidence level's falling. But the good news is the S&P 500 and the markets in general went up last week very nicely. And is there any good news in risk versus opportunity? Well, yes, there is. Again, you can see the price movement higher here, and you can see that the risk acceleration has been pulling back recently. It's below 70. I'd like to see it below 60. If this trend continues, it will get there. And what I really like here is the opportunity acceleration started moving higher back here, even as equities were pulling back, and it continued moving higher. So this looks very, very promising. And what about equity versus safety? Well, let's jump right into the overlays. You can see it's been quite a ride here. You had small caps up here at number 1 7 weeks ago. They fell right down here to 10th place, back up to second, and the NASDAQ was up here in first. This was a great market back here on August 30th. And then things just started to fall apart. And where are we today? All the equities are ranked in the bottom dead last 4 positions for equity versus safety. And because of that, cash has moved up. So this doesn't look good currently for equities. But this is not the story that's being told in all the metrics. And then what if we take a look at safe haven assets? Well, you can see that long duration treasuries, EDV, were right up here in first place for 3 weeks. TLT was up here in second place for 2 weeks. Then they kind of collapsed down here, and equities looked very, very good on August 30th, as I mentioned earlier. And now you can see there seems to be a flight to safety again. EDV is up at the top, followed by 20-year bonds, followed by intermediates, followed by cash, and then short duration treasuries and gold are down here, with equities all the way at the bottom. Does the buying and selling pressure tell us anything here? Well, what I do like is you can see that while the buying pressure, the solid gray line, was collapsing, falling in every single case here, it has recently turned sharply higher, except in the NASDAQ 100, although it is above the selling pressure, this orange line. And you can see it's higher here, and it's shooting higher for small caps. So this looks encouraging going into next week. And what about ARK Innovation? Well, you can see that the buying pressure, just like everything else, was falling off here. Selling pressure was coming up, but you can see that the selling pressure has collapsed. I'd like to see the buying pressure move much higher at a much quicker pace than this, with the price action going up like this. How does this show up in the sector rankings? Well, we're going to kind of skip past the sector rankings because if you've heard my videos before, these move very, very slowly. They give you a look into the rear view mirror, not into kind of where we are or where we might be headed. So let's take a look at sector rank acceleration. And the easiest way to do this is to jump right into the overlays. So what looks good here? Well, quite a bit. You can see that consumer staples have stayed put. Broad index Dow Jones Industrial Average has moved up. Now this is a brown line because the Dow moving up is a flight to safer equities. So it's equities moving up. That's good, but it's a flight to safer equities, which is not good. So, if you combine green and red, you get brown, and that's what you got here. You can see that cash moved down a notch. That's great. You've got emerging markets moving higher. That's great. Bitcoin stayed put. We've got ARK Innovation moving quite a bit higher in the rankings. 20-year treasuries moving down. That's good because that means that these are getting displaced by higher risk assets. Technology, semiconductors stayed put. Consumer discretionary moved up a couple of notches. This is really good. You've got the S&P 500 moving higher. This is good. XLK technology moving quite a bit higher, leaping up here. This is great. And the NASDAQ 100 moving quite a bit higher. So a lot of goodness here in this chart. What doesn't look good? Well, not too much, really. I mean, there's 1, 2, 3, 4 red lines on here. You've got emerging companies, these are the next 100 stocks in the NASDAQ index, and they are moving lower in ranking. You've got gold moving higher. That's usually not a good thing. You've got clean energy, which is needed to power AI compute farms, moving lower. And you've got emerging companies, small caps, moving lower. So really 4 things that don't look good versus a lot of things that look good in this table. And how are treasuries looking? Well, if we take a look at treasuries, you can see over the past week, we had a very nice, healthy rally. Now, it peaked out back here, it looks like on probably Wednesday, and finished the week lower than its recent peak. Hopefully this isn't a bad thing, but I like the way that this ended the week with the highest risk, longest duration treasuries finishing first, followed by 20-year, and followed by the shorter duration treasuries. This is very healthy. And if we look back over the past month, you can see things fell off, and then we've had a very healthy rally since then. What about year to date? Well, year to date, you can see we've had a very, very healthy rally off this bottom, and we're actually up year to date. And then if we look at the past year, again, we're up over the past year. In fact, the longest duration treasuries are up 10% over a year, which isn't bad for a safety asset. And I fully expect these to go much higher than this in the coming months and even the next year. And how does this show up in the buying and selling pressure? Well, if you take a look at this, we've got a very interesting thing happening here. You can see the way the buying pressure just shot through the roof here and then dropped precipitously here. Same thing for intermediates, big rise, big drop, and a big rise in the selling pressure. Same thing for 7 to 10-year treasuries, big rise, big drop, rising selling pressure. Again, TLT, 20-year bonds. Now, not as big of a rise, but you can see that the buying pressure is dropping and the selling pressure is increasing. Now, why is this a concern? You've got the prices going up in every case, but you've got the buying pressure dropping and the selling pressure increasing. So why is this of concern? Well, if you look at this, I'm just going to draw these lines on one of these graphs because it's true on all of them. But you can see you've got increasing price, dropping buying pressure, increasing selling pressure. This kind of divergence usually spells trouble unless it rectifies fairly quickly. Now, this has been going on for just a very short period of time. So this could easily rectify early next week or not. And what about that yield curve? Well, this is really exciting. I don't have to say inverted yield curve anymore. Hopefully not anymore. Anyway, so now the yield curve is much more normal. It's 6.85 basis points, not inverted. So long rates are higher than the 2-year, which is what you really want to see here. Now, at the short end, they're not going to come down until the Fed lowers rates because the Fed controls the rates here. The markets control the rates here and even here at the 2-year point. So this is not inverted anymore, and you won't see these come down until the Fed actually lowers rates. Now, you can see they are coming down. They've come down from where they were a year ago and even a month ago, but the real action is going to happen as the Fed starts dropping rates. And what's the likelihood they're going to do that this coming week on Wednesday when they meet? Well, look at this. It's 50-50, dead heat even, that they're going to either drop rates by 0.25% or 0.5%. And I think with some of the economic numbers coming out, and as you saw Cathie Wood speak earlier, there's more risk of deflation here than inflation, and the Fed really needs to start to move here. So my hope is they drop 0.5%, not just 0.25%. Now, if we go out to November, this is 0.5% here. This is 0.75%, and this is 1%. So rates are almost sure to come down very quickly as we move into the end of this year and then into 2025. And what about gold? Well, gold, as you can see, has been on a pretty rocky rally here. But if you take a look at the buying pressure, the solid gray line is moving strongly higher here as the price really hockey sticks. and the selling pressure is falling off. This looks very positive for gold going into next week. And how about Bitcoin? Well, Bitcoin has been struggling as of late, as you can see here. And, the price did dip. It is going higher. But you can see that the selling pressure is still above the buying pressure, even though it started to fall off at the end of last week. So if this trend continues and the buying pressure continues moving higher, my hope is this will continue moving higher. As you can see from the price movements and the metrics for equities, the equity markets have been moving higher recently, but the metrics are still struggling with a recent flight to safe haven assets. And treasuries are also higher over the past week, so kind of a mixed picture. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance, rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next time, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind, then it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.